Hey there, Mad Money viewers, welcome back to the show. Today, we're diving into the exciting world of advanced ETF strategies. We're talking about leveraged and inverse ETFs. These are powerful tools for traders, but be warned, they are not for the faint of heart. Leveraged ETFs can supercharge your returns. Inverse ETFs can help you profit when the market goes down, but they come with risks. These are not buy and hold investments. You need to understand how they work before you jump in. In this episode, we'll break down everything you need to know. We'll talk about how they work, we'll discuss the benefits and the risks, and we'll give you some practical strategies to get you started. So, buckle up because we're about to get into the fast lane of ETF investing. Let's start with the basics. What are leveraged and inverse ETFs? These are specialized types of exchange-traded funds designed to achieve specific investment goals. Leveraged ETFs aim to amplify the returns of an underlying asset, often by 2 or 3 times. Think of it like this. If the S&P 500 goes up 1%, a 2 times leveraged S&P 500 ETF aims to go up 2%. This magnification can be a double-edged sword. They use derivatives like futures contracts to achieve this leverage, which can lead to significant gains or losses. Inverse ETFs, on the other hand, are designed to profit when the underlying asset goes down, essentially moving in the opposite direction. If the S&P 500 drops 1%, a 1 times inverse S&P 500 ETF aims to go up 1%. This can be useful in bearish markets. They also use derivatives to achieve this inverse relationship, making them complex financial instruments. Now, here's the catch. Leveraged and inverse ETFs are typically rebalanced daily. This daily rebalancing can lead to performance that deviates from the underlying asset over time. This means that their performance can deviate from the underlying asset over longer periods, making them less suitable for long-term investments. They are best suited for short-term trading, where the daily rebalancing can be more effectively managed. Don't get me wrong, these ETFs can be powerful tools for those who understand them well, but you need to know what you're doing. A deep understanding of market movements and ETF mechanics is crucial. You need to understand the risks involved, including the potential for significant losses, and you need to have a solid trading plan. Without a well-thought-out strategy, the risks can outweigh the rewards. Let's talk about the good stuff first, the benefits. Leveraged and inverse ETFs can be powerful tools in the right hands. Leveraged ETFs can magnify your returns in a short period, sometimes doubling or even tripling the gains of the underlying index. This can be very appealing for traders looking to capitalize on short-term market moves, especially during periods of high volatility. Inverse ETFs, on the other hand, offer a way to profit from market downturns, allowing you to make money when the market is falling. They can also be used to hedge your portfolio against losses, providing a safety net during uncertain times. But here's the flip side, the risks. Leveraged and inverse ETFs are not without their downsides. Leveraged ETFs can also magnify your losses, turning a small dip into a significant financial setback, and because of the daily rebalancing, their performance can diverge significantly from the underlying asset over time, leading to unexpected results. This makes them unsuitable for long-term investing, as the compounding effects can erode returns. Inverse ETFs carry similar risks, and they can be just as volatile and unpredictable. They are not a magic bullet for bear markets and should be used with caution. These ETFs are complex instruments requiring a deep understanding of market mechanics. They are not for beginners. Novice investors should steer clear until they have more experience. You need to do your homework, understand the risks involved, and make sure you are fully prepared, and never invest more than you can afford to lose. Always approach with caution and a well-thought-out strategy. Section 4. Types and usage of leveraged and inverse ETFs. Now, let's explore the different types of leveraged and inverse ETFs available. These financial instruments are designed to amplify the returns of an underlying index or asset, either positively or negatively. You have leveraged and inverse index ETFs that track major indices like the S&P 500 and the Nasdaq. These are popular among traders looking to make significant gains from the movements of these well-known indices. You have leveraged and inverse commodity ETFs that track commodities like oil and gold. These can be particularly useful for those who want to speculate on the price movements of these essential resources. And you have leveraged and inverse sector ETFs that focus on specific sectors like technology and healthcare. The possibilities are endless. These allow investors to target specific areas of the market they believe will outperform or underperform. But remember, with great power comes great responsibility. Leveraged and inverse ETFs can magnify both gains and losses. These ETFs are not your typical buy and hold investments. They are trading tools designed for more active management. So how can you use them effectively? Understanding the strategies behind these tools is crucial. One popular strategy is short-term trading. Leveraged ETFs can be used to capitalize on short-term market swings, allowing traders to potentially make quick profits. You can use leveraged ETFs to capitalize on short-term market swings. These instruments are designed to provide multiple times the daily performance of the underlying index. You can use inverse ETFs to profit from market dips. Another strategy is hedging. This can be particularly useful during periods of market volatility. You can use inverse ETFs to protect your portfolio from losses in a declining market. By understanding and utilizing these strategies, you can make the most out of leveraged and inverse ETFs. Section 5. Regulatory warnings and conclusion. Before you jump into the world of leveraged and inverse ETFs, be aware of the regulatory warnings. The SEC and FINRA have issued warnings about the risks of these products. They are not suitable for all investors. They are designed for sophisticated traders who understand the risks involved. So there you have it. Leveraged and inverse ETFs can be powerful tools for traders, but they are not for everyone. They are complex, risky, and require a deep understanding of the markets. That's all the time we have for today. Stay tuned for our next episode where we'll explore sector rotation strategies and how to use options with ETFs. Until then, happy trading.